According to the ACCT Financial Accounting Textbook, adjusting journal entries are entries made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. This method is utilized to ensure that revenues and expenses are correctly noted under an accrual basis. Adjusting entries is the fourth step in the accounting cycle and occurs at the end of each accounting period after a trial balance is prepared. But what's the purpose? Well, the goal is to easily illustrate when the money actually changed hands and to convert real-time entries to entries that reflect the accrual accounting system. There are 4 different scenarios that initiate an adjusting entry for a company and show why it is necessary. These are deferred revenue, accrued revenue, deferred expense, and accrued expense. Here's a simple example. On May 1st, Donald orders a 6-month movie subscription for $600 with Netflix. The company has received Donald's money before the subscription has begun. This is known as deferred revenue. The term deferred is used as at the time of the cash receipt, the services have not yet been provided. Therefore, a revenue cannot be recorded in the system until it is earned. For the initial journal transaction, Netflix increases cash by the amount received, and because the company now has the obligation to provide movies to Donald, the entry increases a liability called unearned subscription revenue by the same amount shown in the table. On July 31st, Netflix prepares financial statements. As of this date, Netflix has provided 3 months of movies and has therefore earned 3 months of revenue or $300. Because the accounting system does not yet reflect this earned revenue, the following adjusted entry should be made on July 31st. This entry decreases the liability account unearned subscription revenue, recording a debit, and increases the subscription revenue account by the same amount, recording a credit. As a result, liabilities are decreasing and equity is increasing. The next step is posting the entry to the relevant T accounts as follows. Cash will remain the same, $100 will be debited on unearned subscription revenue, creating a total of $1,100, and $100 will be added to subscription revenue. The final steps include preparing an adjusted trial balance and financial statements, which is followed by the closing process where all revenue, expense, and dividend account balances are transferred to the retained earnings account.